Hello trading friends, it's Tuesday again, and that means we are going to have coffee together again. And today we're going to talk about slippage. I've received a few questions recently regarding slippage. What is realistic slippage? What slippage we should count in for every standalone, every single futures market? And the truth is that the situation with slippages has improved significantly during last, let's say, 5-6 years. I still remember that 6-7 years ago, it was quite challenging to get good feel and get some reliable metric when it comes to slippages, how much of a slippage we should really put into our backtesting, into our testing. But as technology evolves, so do stock exchanges and futures exchanges, and obviously they've been updating their technology, because on average I'm pretty happy to say that the situation definitely is better than what I remember. So what is the slippage you should include in your testing? First of all, there are some old unrealistic numbers which you can find on the internet, and these numbers, these slippages, are overly pessimistic, which means that a lot of traders struggle to develop a trading strategy with a reasonable average trade. But the fault really is not that they would do something bad, but because they're including overly pessimistic transactional costs, overly pessimistic slippages. And from my own experience, a realistic way right now to simulate a slippage is just one tick on entry and one tick on exit on average. Of course, there will be some markets which will be more gracias. That's the coffee guys. Cheers, that's the coffee, they just brought it to me. So of course there will be some markets which are more challenging, like silver. You will have more of a slippage on silver. You will have more of a slippage on cotton and coffee. These are tiny markets, and you will probably get 1.5 or even 2 ticks on average. But these are also markets that you should not focus in the very beginning at all. You should just focus on the general markets like indices and markets like some metals, like gold and energies, and the usual markets that I like talking about in the masterclass and in other BTA material. And with these, you can pretty much work with just one tick slippage and on entry level and one tip on the exit level. So two ticks slippage per round, per position. That's pretty good for the beginning. Of course, this fluctuates. When there's a higher volatility, then the slippage can be 2, 3, 4 ticks. It can be much higher. And then traders freak out and they're reaching out to me and they're like, Tomas, you said that it will be 2 ticks round turn on average. What's going on? Well, it's on average. You will have periods when it will fluctuate and it will be higher, but you will also have periods when you will have no slippage whatsoever, like 0. So long term or mid term, it averages down 1 tick on entry, one tick on exit, at least from my own experience and from the data that we've been collecting in our hedge fund. And you cannot really measure this short term. Of course, if your approach will be to look at these numbers only short term, then you will be panicking and you will be what's going on. But again, as I said, there will be many occasions that you will not get slippage at all, or you will also get positive slippages. There are occasions where you will get positive slippage in your favor, especially with stop orders. And I had occasions when I got $120 or $130 positive slippage in my favor. So again, this all averages down through time. So that's the safe guidance. Overall, do not overcomplicate it. Right now, when you start, just for every market, count one tick on the entry, one tick on the exit. That's very, very good beginning. Later on, you can fine tune it a little bit, but that already, this alone should give you pretty reliable guidance. Okay. The one exception is E-mini S&P. This is a super liquid market, and because it's got very high volume, you will get good fills quite often. So for E-mini S&P, count only one tick slippage per round turn, per the whole trade. So it's like half tick slippage on the entry and half tick on the exit. So only count with one. And that's really all. So I hope this was helpful, and I hope that now you understand what numbers you should work with. Please do not overcomplicate it, and at the beginning start with these. These are pretty reliable overall. And let me know what you think, and let me know what your experiences with slippages are in the comments below. I'll be looking forward to seeing you next Tuesday. Meanwhile, happy trading.